I spent well over $200,000 on a crypto income strategy that no one seems to be talking about. And before you skip this video thinking it's just another DeFi scam, hear me out, because it made me over $11,000 in pure income last month alone. But here's the thing, even in bad times you can make money, because this strategy uses a fully regulated ETF to harvest volatility from one of the wildest stocks in the market. So the more volatile it gets, the more money this strategy makes. In this video, I'm gonna break down exactly how this strategy works, and by the end, you'll know whether this is the most overlooked crypto income strategy or just another way to slowly bleed your capital. The strategy I use is built around an ETF called MSTY, and here's exactly what we need to know about it. MSTY is an ETF created by YieldMax, an asset manager that specializes in something we call single stock covered call strategies. In other words, MSTY mimics owning MicroStrategy stock by using options, specifically by selling call options on it. When traders buy those calls, MSTY collects a premium, like an upfront payment. Those premiums are then distributed to shareholders, investors like myself as monthly income. It's like watching traders chase candle and gamble on direction while you collect their premiums. And the wild part is MicroStrategy doesn't even need to go up in order for this to work. It just needs to stay volatile, because the more insane price swings, well, the higher the premiums. Just look at this payout history. March, $1.34, April, $1.34, May, $2.37, June, $1.47, and July was $1.24. If you analyze the last few months, the math says over 100%. But realistically, factoring in the ups and downs, the rolling yield sits closer to 45 or 55%. And with a few $1,000s, that might not seem like much, but with $200,000 at work, those option premiums stack up quickly. And this kind of wild price action is exactly what MSTY was built to harvest. You're not just betting on price anymore, you're betting on volatility, which makes it one of the smartest ways to ride the Bitcoin momentum and actually get paid for it. But a product like this wouldn't even be on my radar if everything else in crypto wasn't so broken. And that's what I'll teach you right now. Look, I didn't even care about income ETFs 6 months ago. I was farming yields on chain, staking tokens, and flipping altcoins, chasing passive returns that felt anything but passive. You know the type. They're always like, this pool pays 300% APY if you lock it in for 90 days, and then in 48 hours, the protocol collapses or your token goes down 50% while you're still earning. If you take a look at the spike right above, that's the 10-year treasury yield hitting 4.3%, supposedly the safest yield in the world. But with inflation just under 4%, your real return is basically flat. And below that line, you're actually losing money after tax. It's not just treasuries, CDs, dividend ETFs, sure, they're stable, but they don't generate real usable income, especially not for crypto investors where volatility is the whole game. So most investors did exactly what I did. They chased the next best thing, risk. Only most people don't have any idea what they're actually risking, because you see 10%, 18% yields on ETH staking, liquidity pools, vaults, and it sounds great until you pay attention to it. The math falls apart. Here's what it looks like when you actually break it down. You start with an 18% yield. Now subtract 10% in platform fees, that's 1.8% gone. Then there's gas. If you're compounding or restaking, that's another 1%. Now Ethereum drops 20%, and suddenly your whole principal just shrank to a negative 5%. If you're in a pool, it's another 2% for impermanent loss or slippage. So that 18% headline, well, it ends up looking more like a negative 7% when the real market hits. And that's assuming nothing goes horribly wrong. No rugs, no smart contract bugs, no DPEX, it's just normal volatility, and you're already in the red. Then there's DeFi. Protocols like Pendle, Curve, and pre-crash Anchor were throwing out 20%, 30%, and even 40% APYs. I mean, Anchor alone had $17 billion in TVL, promising a fixed 20% yield. See this green stretch here? That's billions of dollars flowing in. Now look below. That massive red dip in May of 2022, that's when the UST collapsed and the entire ecosystem crashed in under 60 days. It wasn't real yield. It was inflation disguised as passive income. All they did was print tokens, slap an APY on it, and wait for someone else to buy in so that they could cash out. After going through breakdowns like that again and again, I realized something. I was stuck between two bad choices. TradFi that barely beats inflation, and crypto income that feels like a trap half the time. So So I started asking the same question alongside everyone else posting on Reddit and Twitter. Where do I park cash for real income? And that's exactly why I started looking outside and discovered a product like MSTY. Now, when I say I discovered MSTY, I don't mean I just saw a video and jumped in. It started when someone I met, British Hodl, talked to me about this fund that I had never heard of, MSTY. I was so confused at first because the dividend looked fake and the yield made no sense entirely. Like, bro, this can't be real. With Coinvo, I got together every piece of information I could find. I read the docs, I traced the strategy just to fully understand how MSTY worked. I even checked the options flow to see if the math made sense. Because after getting burnt by so many yield traps, I wasn't gonna fall for just a shiny number again. I wanted to know if this thing was legit, not just on paper, but in real cash flow. That's when I realized MSTY wasn't playing the same game. It uses something called a synthetic cover call strategy. If that sounds complicated, don't worry. I'm gonna break it down into 3 simple steps. Step 1, synthetic long exposure. This is the part that threw me off. Turns out that MSTY doesn't actually own MicroStrategy, not even a single share. And when I first saw that, I thought, wait, how is it paying me yield off of something it doesn't even own? Well, instead, it built something called a synthetic long position, which is just a fancy way of saying it buys a call option, sells a put option, both at the same strike price, same expiration date, and same level. And this combo, long call plus short put, moves almost exactly like owning the stock, but it's cheaper, more flexible, and it lets MSTY play the same upside without ever touching MicroStrategy shares directly. And that's how MSTY mirrors the price moves of MicroStrategy while keeping more cash on the side for the next step of the strategy. Now that MSTY has synthetic exposure to MicroStrategy, it turns around and does something really smart. It starts selling call options against that synthetic position, basically offering to sell it if price goes above a certain price. At this zone, this is where they sell the calls. If MSTR stays under $1,550, the call expires worthless, and MSTY pockets the premium, which later on gets paid out to holders like me as a monthly income. This is the part that helps MSTY manage its operations and maintain liquidity. When you invest in MSTY, only part of your money goes into the option strategy. The rest, around 2/3 or so, stays parked in cash and short-term treasuries. That cash cushion helps the fund operate smoothly and manage the options premiums. But here's what's important to understand. This doesn't protect you from losses. If MSTR crashes 20%, MSTY will still take a significant hit and crash alongside it. That cash cushion helps with operations and liquidity, but you're still fully exposed to MSTR's downside moves. And that's the trade-off. You get the income from selling calls, but you don't get the downside protection. MSTY resets the strategy every month. It sells a new set of call options, collects a fresh premium, and sends a distribution check to shareholders, which essentially means some months are thick while others shrink. But as long as volatility is alive, MSTY keeps getting paid, and so do its holders. Once I understood this, it clicked, and that's when I decided to put real capital into it. While most people would have gone with a small amount as a test investment, I was quite confident on this one. So I did what any sane human would do. I went all in with $200,000. And looking back, this decision has gotten me over $50,000 over the last 4 months. But before I got carried away with what I could get out of this, I needed to understand the risk and misconception. I mean, it's literally $200,000 on the line. I couldn't afford to flop this. Now, from the research, it's clear that MSTY isn't some free yield machine. It's a structured trade. And if I didn't understand the risk, it could bleed my entire capital quietly. So here's what I got. First, the misconception. MSTY is an income product, not a growth product. And an income product like MSTY is personal. So if you're 18, living at home, and you may have $5,000 to your name, this isn't for you. You're better off chasing growth product like Bitcoin or even invest in a business. But if you're 40, married with 2 kids, and you've got bills or monthly expenses, then yeah, MSTY can be a tactical income layer in your portfolio. Another thing you need to understand is that MSTY's maximum cannot be more than 15% of your portfolio because it's only income, not growth. Don't get that confused. In the Bitcoin Trinity, MSTY fits into the small earn section, while safe hold long-term assets like Bitcoin and invest targets 3 to 5 year profit opportunities. Now we've got the risk. Let's start with the most misunderstood part, return of capital. In May, MSTY paid $2.37 per share. Sounds like a good thing if you'd ask me, but let's go deeper. Most of MSTY's payouts are classified as return of capital, with only a small portion being actual income. That means means the fund is often paying you back with your own capital, not new money. So if MSTR isn't climbing fast enough and MSTY keeps paying out at this pace, you're not just earning yield, you're quietly liquidating your base. Looking back at when MSTY launched around $20, it's now trading at about $17. This modest decline isn't just market noise. This is what happens when distributions consistently come from your own capital rather than true income generation. One analyst put it perfectly. MSTY is an income fund that can decay over time if you hold it too long without reinvesting. Unfortunately, they're not wrong. When most of your yield is actually return of capital, you're essentially getting paid back with your own money. If you keep collecting your payouts without reinvesting, you're slowly liquidating your position from the inside out. Here's another truth. MSTY caps its gains. If MSTR triples, MSTY won't. Watch this. Bitcoin moves 2x, MSTR jumps 2.5x, MSTY stays flat after the strike. Why? Because it's already sold the upside for income. That's the trade-off. You're collecting nickels in exchange for moonshots, full downside. While MSTY capture upside, the downside is wide open. That is, if MicroStrategy tanks, MSTY takes a hit right alongside it. You might have sold off your moonshots to the upside, but you're still exposed when things crash. MSTY isn't some boring yield ETF. It moves. Intraday swings of 3 to 6% are not uncommon because MSTR is volatile. And this ETF tracks that volatility with leverage built in. MSTY only launched in early 2024. It hasn't gone through a full crypto bear market. We've only seen how it behaves during a Bitcoin recovery phase and mild choppiness. $4.8 billion in AUM shows interest, but it doesn't prove the model across cycles. The fund charges nearly 1% per year. That's high for an ETF, but low compared to hedge fund strategies. If you're making 100% yield, it's fine, but it still eats your return. Most of MSTY's distributions are ROC tax deferred in the US, but taxable as income abroad. Foreign investors may get hit with a 30% withholding unless there's a tax treaty. US investors will get a 1099 DIV showing mostly Box 3, non-dividend, and Box 1A, ordinary income. We'll break this down fully in the next section. So yes, MSTY pays fat yields, but that yield comes at a price. You're trading long-term growth for short-term cash flow and slowly drawing down your principal unless you reinvest. Now, with a smaller position, this might not scare you. When you've got $200,000 on the line, every percentage point matters. If I don't manage this right, I'm not just risking yield, I'm risking capital drain. So, how did it actually perform? Let me show you exactly what MSTY paid out and what I got to keep month by month. I'm just gonna work with the last 4 months payouts. So, let's get into it. The most anticipated moment of the entire video. March, $20.33, April, $24.34, May, $21.55, June, $22.17, and July, $20.83. This is what MSTY paid out in real distributions over the last 5 months before tax, starting from March down to July. And as you can see, the payout varies based on volatility, as I've explained earlier. Now, these are just a bunch of figures on a screen, and y'all might be wondering how these figures actually work. So let's break this down using May as an example. Back in May, MSTY's average price that month was $21.55. So with my $200,000 investment, I ended up holding around 9,281 shares. Then MSTY paid $2.3 per share in distributions that month. Multiply that by the payout share. That's $22,000 in pure cash income in a single month. And that's how this strategy starts to stack up, especially when you're playing with size. From our $200,000 position, we've made over $71,000 in the first 5 months. But now let's talk about what I got to keep after tax. So here's how it breaks down for US investors. There are 2 parts of the 1099 DIV form. Box 3 equals return on capital, which is tax deferred. Box 1A equals ordinary income, which is taxed at your regular income rate. Most of MSTY's payouts are classified as return of capital, with only a small portion being taxable as ordinary income. So on most payouts, only a small fraction gets taxed now. The rest doesn't get taxed until you sell your shares. And that's powerful powerful because you're keeping almost everything. But don't get it twisted. ROC just delays the tax. Keep in mind that it's still your own capital being paid out and your cost basis drops. So even in higher brackets, the tax drag is minimal. If you're in a tax deferred account like an IRA or Roth, you pay zero tax now and you get the full yield up front. On my own $200,000 position, from every breakdown, it's set to produce at least $148,000. That's literally a 74% yield, and with such an outcome, my portfolio could be valued at $348,000. Of course, that's assuming current payout trends continue, which isn't guaranteed, but it gives you the scale. And right now, the engine is running hot. We're in one of the most aggressive volatility cycles Bitcoin has ever seen post-halving, and MicroStrategy is moving even harder, which means options premiums, the fuel behind MSTY's yield, is near peak. Timing is everything, especially with a strategy like MSTY. The last Bitcoin halving happened in April of 2024, and historically, the 6 to 12 months that follow are where volatility spikes and new market cycles begin. Back in 2017 and 2020, after each halving, Bitcoin didn't just climb, it accelerated violently. And that volatility, that's exactly what powers MSTY's income engine. Take a look at this slice. Bitcoin pushed 18% in a month, and MSTR moved over 40% during the same stretch. That kind of movement is premium paradise for option sellers. The more the market whipsaws, the more MSTY can harvest. So if you're entering MSTY during low volatility, you're getting less juice. But entering right now when MSTR's premiums are elevated, that's when the yield looks like this. Implied volatility is up, strike ranges are wide, and call premiums are thick, meaning MSTY is locking in serious cash without needing MSTR to go parabolic. It's not about buying MSTY forever, it's about knowing when the odds are stacked in your favor. And right now, post-halving plus peak volatility is exactly that window. But this isn't for everyone, and it's not permanent. So here's the bottom line. MSTY isn't here to make you rich overnight. It's here to pay you monthly in a market that usually doesn't. It tracks MSTR, it sells covered calls, it pays you, which is often tax deferred, and yes, you give up moonshots in order to do that. Over here in the last 3 months, it's paid over $2.20 per share. If you bought low and reinvested, you've already earned back nearly 75% of your position. But that still doesn't make it for everyone. If you're expecting a 5x upside, this isn't your trade. If you panic when the NAV drops, this isn't for you. If you're chasing price and not income, this definitely isn't for you. But if you value monthly cash flow, this is for you. If you want to monetize volatility and not gamble on it, this is for you. If you're building yield inside of a tax advantage account, this is definitely for you. For me, it works. It fits a specific role within my portfolio, and right now, during this volatility window, it's one of the few things that is actually paying me. That's the key. This isn't passive, it's tactical. Now the lid's off. Let's talk execution. I just mean where you can actually get MSTY. But you get it already, especially after watching this video. So MSTY is listed on a New York Stock Exchange and available on most major brokerages. If you're based in the US, the two I'd personally recommend are Robinhood and Webull. Both are fully regulated, have zero commission trading, and offer a clean interface with great mobile tools. If you're outside the US, your best bet is probably Interactive Brokers. They support international accounts, give access to US markets, and have one of the most advanced platforms out there. I spent $200,000 on this ETF to figure it out for you. Now that you've seen how it works, the structure, the strategy, the trade-offs, you know exactly what to do. Time it right, size your position, and track the volatility just to make sure you're not the one holding the bag when the premiums vanish.